All right, my clock shows 10:01. I think we can get started here. Good morning. I hope everyone had a good Christmas and New Year season. We have some new viewers today, along with some veterans. So I want to take this moment to introduce our not-for-profit team. My name is Tyson Moore. I'm an accounting supervisor in the not-for-profit division here at DWD. With us today are directors Susan Berghoff and Phil McKinsey, and our presenter and DWD partner, Carrie Minnick. So before we get started, I have a couple housekeeping items to cover. For those of you who have questions during today's webinar, use the Zoom's question and answer feature. You should see that option on the toolbar at the bottom of your screen. We will be answering questions periodically throughout the presentation today. Also, Carrie's slides will be emailed to everyone attending the webinar today, along with being posted to our website after the presentation is finished. All right, with that being said, I'll turn the floor over to Carrie to start today's webinar.
Thank you, Tyson. Today, we are going to talk about nonprofit policies. And some of these are going to be policies that are required by the IRS or different oversight bodies. Some of them are going to be more of highly recommended. We really encourage you to have these, but they're not required. And then some are just some other ones, best practices. As we go through these, I'm going to touch on each one of these policies. Obviously, this is not an all-inclusive list of every policy that your organization might have. Some policies may not apply to your organization, therefore you don't need them. And some of these, as we go through, I'm just going to touch real briefly on them because they are not going to apply to a lot of organizations, but I did want to mention them. So as we get started, we'll start at the very beginning. So when your nonprofit goes and applies for tax exemption from the IRS, there are some policies that the IRS asks that you have in place. And so since all of you are already a nonprofit that has received your tax exemption status, hopefully you already have all of these in place. However, it is good to go back and review these. So we will start very beginning with the mission. And this really isn't a policy, but it is still a written statement. It's, your reason for existence. And it's important to regularly review your mission statement. Not only is this reported on your 1023, your tax exempt application, but it is reported every year on your Form 990. So that's why it's important to go back and have your board review it every year to make sure that what your mission statement says is that you are continuing to do. Sometimes there's mission drift or there are changes to what an organization does and we need to change our mission, and that's fine. Other times the organization does start doing other things, but that's not good because we want to keep it to what's in our mission. So it's very good idea to every so often go back and review your mission to make sure that your activities are in line with what that statement reads. Next is your articles of organization. So this is a written document that you would have filed with the Indiana Secretary of State. And it has to have specific wording as a nonprofit, as a tax exempt entity. There on the screens, there are some specific wording that need to be included in the articles. Sometimes articles of organization, your articles of incorporation need to be amended, which is perfectly fine. So you do have to file those with the Indiana Secretary of State if you do have amended articles. Normally that's if a change in year in, change in name, something major to the organization. So oftentimes an amendment is not necessary. And you can see the suggested language for nonprofit articles on the IRS website, and I provided that link on this slide. Next are your organization's bylaws. So again, as an organization that's already in existence, you would have already had your bylaws written and approved by the board. However, just like your mission statement, it is very good to go back and review your bylaws. Things change and sometimes we need to go back and amend our bylaws. There are no specific required language that needs to be included in your bylaws. There's nothing that says you need to have this included. However, there are some suggested items such as, your official name, what your purpose is, specifics about your board, how many people, minimum and maximum number, how often are your board meetings, who your officers are as far as the positions and what their responsibilities are. So you can see on the screen there are some suggested items to include. When you're creating your bylaws or amending your bylaws, You want to make sure though that you don't get too detailed. For example, you don't want to put anything in there about you use XYZ bank or you use XYZ accountant as a contracted CPA, because those things change, and and if you do include those in your bylaws, then every time you change that, you're going to have to go back and amend your bylaws, which is going to require a vote by the board. So keeping it high level, your internal operating rules for your organization should be included in your bylaws. Next is compensation. So again, when you go and apply to be a nonprofit, the IRS asks questions regarding compensation. Also, on your annual Form 990, there are questions about compensation. There is no mandated process for determining compensation. However, compensation of executive directors and CEOs of nonprofits is a very big topic with the IRS. They want to make sure that you're documenting how you're determining what you're paying your ED and what that is. So making sure that you are looking at comparable organizations to see how much they're paying their executive directors. And comparable means, similar services, similar area. So as in Indiana and Fort Wayne, we're not going to compare our organization to somewhere in New York. That just doesn't make sense. So because the 990 asked this question and the IRS does on the 1023, we want to make sure that we have some kind of written policy in place to say, how are we going to determine our executive director's compensation? Is it determined by the executive committee? Is it determined by the entire board? Maybe there is, if you're a larger organization, maybe there's an HR or a compensation committee. So who is determining that? And then also, how are we determining it? What kind of comparability data are we looking at? And then we also need to document it. So in the minutes of that group of people, we need to document how we're determining what we're going to pay our CEO. And one thing that you can use for comparability is, at least for those in Northeast Indiana, there is a Northeast Indiana nonprofit salary survey that's available. And I provided the link here that you can go out and look at that. That provides salary and benefits for CEOs, EDs, fundraising professionals, all the many different levels within an organization. So you could use that. You can also go to the IRS website and look up different organizations' 990s. If the 990 is prepared correctly, you will be able to find the salary and benefits of the executive director on the 990 as well. There's also other websites, GuideStar, Candid, that you can look those up as well. So that's some areas where you can go to find comparable salaries for your executive director. Next is the conflict of interest. So I've actually heard that the IRS will not approve a tax exempt application without an organization having a conflict of interest. So it's very important to make sure that you have one of these in place. And again, most of you probably do, but just make sure that you review it to make sure that it is still relevant, and then also that it's being implemented and used. Form 990 also asks about the conflict of interest. Do you have one? Is it being implemented? Is it being monitored and enforced, and how? And then also, are you requiring your board members, management to sign it every year to disclose those potential conflicts? The actual policy itself should include what the definition of conflicts are. So, let's say one of your board members is married to someone that has an advertising company. So that's okay for your organization to use that advertising company as long as that advertising company and that board member don't receive any kind of special benefit because of that relationship. And so that's why we're disclosing that potential conflict on this statement each year so that everyone is aware of it. And then also, how are you going to manage those conflicts? You don't just want to have this policy in place, have people sign it, and then be done with it. There needs to be some kind of process in place as to when these potential conflicts come up, how are they addressed? Is that board member or that person, do they refrain themselves from the discussion? Are they allowed to vote? What happens then? So actually implementing the policy as well as just having it. The final policy that is required as part of the tax exempt application is a non-discriminatory policy. And this relates to schools. And specifically, if you are a school described in the section highlighted here on the screen. So a lot of you are not, so this probably doesn't apply to you, but if you are a school, a specific school, then you must have a policy stating racially non-discriminatory. There's some rules as to where it needs to be put on your website and advertising. So just make sure that if you are assigned that school category, that you do have one of these policies in place. So again, most of those you already have in place because you have been in existence for a while. So now we're going to move on to some more that Form 990 requires. So we've already talked about the mission. Before we get into this into depth as far as the 990, most of the policies that Form 990 asks about are included in Part 6 of Form 990. So when the 990 was redone back say 2008 or so, they revamped it and asked a whole bunch more questions about governance, policies, procedures, that kind of thing. Because the IRS wants to know more about this type of thing. They think that if an organization has these written policies in place, that they are better managed, that they are more likely to follow the rules. But if on the 990, these policies that they ask, they do disclose that these policies are not required by the Internal Revenue Code. However, if they are asking them, they probably want you to have them in place. But again, these policies are not required by the Internal Revenue Code. So the first one that they ask about is contribution substantiation. Now, again, the 990 doesn't ask if you have a policy in place for contribution substantiation. It asks whether the organization has notified donors of the goods and services provided for payment, including contribution and exchange. So they're asking you if someone comes and pays you, makes a payment to you of $75 or more, that includes both an exchange portion and a contribution. So let's say for like an event where there's a dinner and the food cost is $20. So the rest of it, $55, is going to be a contribution. If that happens, are you notifying them how much of that $75 payment is a donation versus an exchange transaction? So since they are asking you if you do this, it's probably a good practice to actually put a policy in place to make sure that you do this. So the basis of this is that individuals who want to make a donation and take that as a charitable deduction on their tax return have to have a written acknowledgement from the charitable organization if the amount is $250 or more. It is the responsibility of the individual, the donor, to get that substantiation from the organization. However, it's really best practices for just as a nonprofit to provide that to your donor to make it easier on them. So what you need to provide to them is what's listed on the screen there, the name of your organization, the amount of the cash contribution. If they give you non-cash, if they donate you supplies or books or something like that, you would just say, thank you for your donation of 20 books on whatever date. You would not include the dollar value. That is up to them for non-cash items. You also must include a statement that no goods or services were provided by the organization if that is the case. So if it's a straight out contribution, I'm giving you $500, I'm not giving anything back in return, that's the statement that you would use. However, if I buy a ticket, $100 to attend your dinner, $25 covers my meal, $75 is a contribution, you would not use that statement, but you would say in return, you received a $25 value of a meal. So just making sure that you have that process in place. And again, because the IRS is asking you whether you do this or not, it's probably a good idea to have a written policy in place to make sure that that gets done every year. Next, on the 990, the IRS asks you about your minutes. So again, it's not asking you if you have a policy in place to take minutes, it's asking you if written minutes are being taken. So because they are asking you if it's being done, we should probably have a policy in place to make sure it gets done. So as far as minutes, making sure that they're contemporaneously documented, making sure that you're noting the actions that are being taken, who is in attendance. And this should be minutes of all the governing body, which is your board, and those committees that have authority to act on behalf of the governing body. So it's really good practice just to take minutes at any committee meeting, so that way we know what was documented. But if you don't already do this, make sure that you are taking written minutes. The Form 990 also asks if policies are in place to govern chapters. So if your organization has multiple locations, multiple chapters, the IRS wants to know if you do have policies in place to govern these other locations. They want to make sure that the operations are consistent throughout the whole entire organization, which includes those different chapters. This probably doesn't apply to a lot of organizations, but those that do have multiple locations, multiple chapters, this is going to apply to. And so again, it's just having a policy in place as to how operations are done, making sure again that each location, each chapter is doing things consistently. Form 990 also asks what the process is to review Form 990. So again, because they're asking you about a process, it's probably a good idea to have a written policy in place to make sure that this practice gets done. So the question on the 990 first is, was a copy of Form 990 provided to the voting members of the organization's governing body prior to filing the IRS? So in order to answer yes to this question, the Form 990, an exact copy of what is being filed to the IRS, so all of the schedules, the Schedule B that lists the contributors with their names and addresses, that exact copy has to be provided to all board members. It can be emailed out to everyone, that's fine, but it needs to be done prior to the filing of with the IRS. So that's the first part. Then it also asks, how are you reviewing your Form 990? So does the board review the 990? Does the finance committee? Does the audit committee? How is that process being done? And they're asking this because they want to make sure that the governing body members, the board members, are active within the organization. They want to know if they are aware of what is being filed on your Form 990. So hopefully, if you don't have that policy in place, that's something you can think about putting in place. Okay, whistleblower. Whistleblower, along with the next policy we're going to talk about, are actually two policies that are required by Sarbanes-Oxley. So way back in 2001, 2002, when we had the whole Enron issue, it resulted in the Sarbanes-Oxley Act, and there were a lot of items in this act that applied to for-profit entities. However, these two items apply to nonprofits as well. So a whistleblower policy allows staff, board members, volunteers, anybody within the organization to report suspected wrongdoing within the organization. So it really helps the organization become aware and address problems before serious harm is done to the organization. It also needs to state that if someone were to report anything, that there's no blowback against them. So if I thought something was going on in my organization, who do I talk to? Is there a phone number? Is there somebody I need to email? Smaller organizations, maybe it's your board chair, just making sure everyone is aware of who that is. So who do I contact? Who do I report that to? And then also in the policy, it needs to know that if I do report that I am not going to get fired. I'm not going to get demoted for doing this. So again, like all of these policies, does the existence of a policy assure good behavior and compliance? No, not really. But having the policies in place are going to provide a framework which an organization's directors, employees may use to address these kind of issues that arise. So being preventative in that. Document retention and destruction policy. This is the other policy that is required by the Sarbanes-Oxley Act for nonprofits. So the 990 also asks if you have one of these policies in place. This policy is going to include what kind of documents you maintain. So bank statements, minutes, audits, Form 990. How long do you keep them? And then how are they destroyed? So when it's time to get rid of them, what does that process look like? Your organization can maintain these either electronically on paper, doesn't matter, whichever is fine, just make sure you document that. Now, when you're thinking about how long to maintain different items, there are kind of some best practices that, okay, these are normally kept forever. These items are usually kept 7 years, but you also have to think about outside oversight organizations. So some state and government agencies that do vary from government entity to government entity, state to state, they may require you to keep certain documents related to certain grants that you got from them or programs for a different amount of time than someone else. So if you do get government grants or have some kind of government reporting, you want to make sure that you reach out to them and find out how long they require you to keep these documents. Your document retention and destruction policy also needs to include wording that prevents any destruction should litigation occur or potential litigation. So if someone says they're going to sue you, or if there's a lawsuit in place, you need to have something that says we are going to cease all destruction of documents. And here's just kind of a very, very high overview as far as certain documents. So there are some documents that you're going to maintain permanently. You know, that's your application for tax exempt status, your IRS determination letter, your articles, bylaws, board minutes. There are some documents that related to HR employee that you have to keep for at least 4 years. The IRS requires that. And then other documents that maybe don't fall underneath of these, or you don't really need them to prepare your 990, but how long should we keep those? So that's kind of the other area that you need to determine how long you're going to keep certain items. DWD does have a template document retention destruction policy that does include a list of specific nonprofit documents and how long each should be kept. So if that is something you'd like us to send us, we're happy to do that. And along with all of these policies that we're going to talk about, we have a lot of templates for these. So if there are ones that you want, we can certainly provide those to you. Form 990 also asks about joint ventures. So this is when your organization decides that it's going to go in on an activity with maybe a for-profit, maybe another nonprofit, but you're gonna work on something together, whether it be a program or some kind of investment. They really want to know that you have some kind of policy in place to control that, as far as making sure that these ventures further your exempt purpose and that they're protecting the tax exempt status of the organization. So making sure that the terms and condition of these joint ventures are fair to the nonprofit. Sometimes a for-profit and nonprofit might go together for a joint venture, and the for-profit might try to take advantage of the nonprofit's tax exempt status. So if you do have some kind of joint venture in place, making sure that there is a policy in place to protect the organization. Okay, gift acceptance policy. So on Schedule M of the 990, that's where we report our non-cash contributions. So that's going to be our in-kind. And on Schedule M, it asks if the organization has a gift acceptance policy in place. So think about your organization. Will your organization accept any gift that anyone offers you? If somebody came by and said, hey, we want to donate this parcel of land to you, would you take it? Or what about a building? Let's say you don't own your building, you've never owned any buildings, you rent your space. If someone came by and said, we'd really like to donate you this building, would you take it? Or what about Bitcoin? I know that's a big one in the news recently. Is that something that your organization would accept? So having a written policy in place really helps both the organization and donors understand what is acceptable to give to the nonprofit. So if somebody comes by and does say, hey, we want to give this to you, you can say, nope, that doesn't meet our gift acceptance policy, so we cannot accept that. What you need to think about when you are putting this policy together is obviously cash, that's easy. Everybody wants cash, that's the easy one. But even investments like stocks, are you able to accept those? Because oftentimes you have to have an investment account set up. So if you don't have an investment account set up, how are you going to be able to accept that donation of stock? And then back to like the land and the buildings, if you've never owned a building, maybe you're not equipped to manage the building. Maybe you don't have enough staff to manage the building or resources, or maybe that building needs a lot of work to fix up, or maybe it is a great building. It's very new, but it doesn't fit the needs of your programs. And so you would have to do a lot of work to reconfigure the inside of that building. So those are some things to think about. Sometimes a gift isn't as great as what it seems. So if you put this in writing beforehand, then you can easily say what you will and will not accept from your organization. So those were, so we talked about basically what the IRS is asking, whether it's through your tax exempt status or through 990. Now, these standards, these policies really relate more to accounting standards. So allocation, capitalization, and endowment. And they do kind of flow over to the 990 as well, but it's really for accounting. And it doesn't matter. Well, let's talk about allocation policy first. So does not matter if you are on the cash basis, modified cash basis, or accrual basis. Expenses have to be allocated, have to be reported by both natural classification. So that's on the left down the side. So natural classification is your salaries, your supplies, your insurance. What kind of expense is that? But they also have to be allocated by function, and function is across the top. So we have program, management in general, and fundraising. So those are your three main functions. There's also a fourth function that has to do with memberships, but we'll just focus on these three right now. When you are allocating expenses for accounting, this is not the same as when you allocate expenses for grants. So you get a grant in and they're saying that they will pay for certain administrative expenses or certain program expenses. Okay, what they're talking about with that is different than what we're talking about here for accounting policies. So what we're talking about here are, again, these three main functions. So let's determine what these are. So program services. So expenses that are allocated to program are those costs to provide your programs or services. So if you have a program director that's in charge of your programs, their salary 100% is going to go to program. If you have supplies that you buy for your program, that's going to go to program. So those expenses that relate to providing that program or service, what you exist for. Now, we also have management and general activities. So management and general activities are really those expenses that you're going to have no matter what kind of program you're doing. Because you are a business, you're running a business, you're going to have certain expenses. So for example, your fees to have your audit done are management in general. Doesn't matter what your programmings are, doesn't matter if a grant says you have to have an audit done, that audit expense should be management in general. Or let's say your fees for payroll processing. Doesn't matter what kind of program you have, those payroll fees, management in general. And you can see here some specific areas that the Accounting Standards Board has described for management in general. The very last example here is, I think, a good one. Nonprofit Symphony advertises the sale of tickets for its upcoming concert season. The advertising expense is considered management in general, even though the concert performance is programming. Promoting ticket sales does not directly accomplish the symphony's mission, nor is it fundraising because ticket sales are not contributions. So you can see there that the advertising of the ticket sales is management in general. And then the final category, or final two categories, is fundraising. These are expenses that you're undertaking to induce people, to entice people to give to your organization. So if you have a development director, their salary, if you have a Christmas mailing that goes out and you're asking people for money, those expenses are going to go to fundraising. If you have an annual fundraising event, those expenses are going to go to fundraising. And then finally, membership development activities. So if you have membership members, those expenses that are related to getting members, advertising to members, that type of thing. So we have the three functions. That's what each of them means. So now we need to figure out how to allocate each of our expenses to those three functions. Some expenses are very easy, they're direct. So again, like your fundraising person, your development director, 100% of their salary is going to go to fundraising. That is direct identification. Super easy. However, you probably have a lot of expenses that are going to go across all of those three functions. So for example, your executive director salary, I'm guessing that they probably do a little bit of fundraising. They probably do a little bit of programming, and they probably do a lot of management in general. So we have to figure out how we're going to allocate their salary across these functions. There's different ways to allocate expenses depending on what the expense is. It's important that you have a reasonable allocation basis. There's not a specific salaries has to be allocated this way, or repairs and maintenance has to be allocated this way. There are best practices, but there's no rule that says that each expense has to be allocated a certain way. So if we go back to salaries, the most common way to allocate salaries is by time. How much time does each person spend in each of those functions? That's pretty easy. Other allocation bases that are used, square feet. So in your building, those expenses, depreciation of the building, utilities, cleaning, those kind of building related expenses are usually allocated by square feet. So how much square feet of your building is being used for program versus management in general and fundraising. Other allocation means is, full-time equivalents, the head counts. You can do it different ways. Again, it just needs to be a reasonable basis. However, please note that revenue is not a reasonable basis. If you are allocating your expenses into program management in general based on revenue, that's not good. We don't want to do that. You cannot allocate your expenses to each of the programs based on how much revenue each of those programs bring in, because expenses are the resources being used for those programs. And so in order to allocate them appropriately, we need to look at the inputs, the resources going into each of these functions, not the outcome, not the revenue. It's also important to note that your allocation methods might change. So if you add a new program, if you have a huge increase in staff or decrease in staff, if you relocate to another building. So it's important to review that allocation policy every year to make sure that it is consistent. So again, it's very important to have some kind of policy in place to determine how you are going to allocate expenses between program, management in general, and fundraising. And then also, it just needs to be a reasonable and consistent basis. So as long as it's reasonable and consistent and you have it documented, you're good. The next policy is a capitalization policy. So if you follow the pure cash basis of accounting, this is not going to apply to you. If you don't have any assets, this is not going to apply to you. So we're talking here about land, buildings, computers, furniture, that type of stuff. So those tangible assets that have an estimated useful life of longer than 1 year under the accrual basis of accounting, and also normally under the modified cash basis of accounting, those items are capitalized and depreciated over their useful life as opposed to expense. So if we do that, we need to determine some kind of reasoning as to what we are going to capitalize so that we can be consistent. So for nonprofits, a very common capitalization policy is $500 or $1,000. So this basically states those items, those, buildings, equipment, furniture, those computers, those type of items that we're buying, if they cost $500, if their policy is $500 or more, and they have an estimated useful life of longer than 1 year, we're going to capitalize that instead of expense it. So if you don't have that in place already, make sure that is something that you put into place if you follow the accrual basis or modified cash basis of accounting. And then the last policy under this section is the endowment policy. So again, if you don't have an endowment, this doesn't apply to you. But if you do have an endowment or you're thinking about having an endowment, you should probably look into this. So first of all, we want to talk about what an endowment is, because the term endowment gets thrown around a lot, and sometimes it means different things to different people. So a true endowment means I'm going to give you $100,000 and you're not going to be able to use that $100,000, but you're going to use the earnings off of that $100,000 to support your operations or your programs. So that's a donor restricted endowment. There's also board designated endowments where the board says, okay, we have this money that came in. The donor said we could use it for whatever we wanted to. We are going to set it aside as an endowment. We're going to use the earnings off of it for XYZ. But because the board set it aside and not the donor, the board can really decide to undesignate it. And if they needed to, they could take that $100,000 and use it for whatever they wanted to. So it's important, first of all, to understand the difference in that terminology. So when you're talking to somebody, you know what you're talking about. So in the policy, we need to include what type of gifts will be accepted. Is it just straight cash? Will you accept investments? What are you accepting? How will the funds be invested? Because you want to invest these funds into some kind of investment account, because that's the whole point. Is the reason that a donor gives you an endowment is because they want their impact in the organization to last a long time, not just the current year, but to last a long time in the future. So that's why they give this to you, you put it into an investment account, and then you use the earnings off of it. So you want to make sure you're getting earnings off of that. And then also, how will the earnings be used? So are there restrictions on it? So how can you take that money out? How often? Is there a certain percentage that you can take out? Can you only take out 2% per year, 5%? When you take that money out, what can it be used for? Sometimes the donor will say it needs to be used for program A. Sometimes they'll say you can use it for whatever you want to. So you need to make sure that that's included. Related to endowments is the UPMIFA, which is the Uniform Prudent Management of Institutional Funds Act. Basically, this just provides guidance on investment decisions and endowment expenditures for nonprofits. So they want to make sure, this act really wants to make sure that you are investing these funds prudently and following the wishes of the donor. So of that $100,000, let's say that the market does pretty bad and it dips down. And let's say that it drops down to $98,000. So we are below that initial $100,000. Is it okay for us to take an organization to take out money to take a distribution from that fund, even though it's already below the $100,000? So that's kind of what UPMIFA is doing, is saying, okay, yes, that's okay if you're prudent about it and you watch how far it's going to decrease. And so those are the types of things that you want to include in your endowment policy. Okay,
Hey, Carrie,
yes.
on the capitalization policy, I've had people ask me this before. Is there I know you talked about 500 and 1,000 being common, but is there a maximum or minimum that they need to address? And how do you, and who makes that determination?
Right. So because we are a nonprofit, no. For-profits do have some IRS requirements. They have like a, not requirement, but like it's reasonable. So like if you have an audit done, the IRS says $5,000, we're good with that. We're not going to question stuff, or $2,500 if you don't have an audit done. But for not, that doesn't apply to us because that's for-profits. So nonprofits need to look to see, what are your activities? So for example, if you have a building, let's say you have a huge building and you buy a ton of assets every year and they're large assets. So if you used $500, that might not be the best amount. You might even want to use $2,500, because if you're buying all of these small, tiny items, is it worth it? And it's such an insignificant amount of your whole entire fixed assets. But if you're a small organization and you don't buy a lot of assets, fixed assets, maybe just some computers every so often, $500 might be more reasonable for your organization, because you're going to have to track the cost of these as an asset. It's going to show up on your balance sheet. So it's going to show up. That's good. It's going to show as an asset. We want it to do that. But then you're going to also have to depreciate it over 5 years, 10 years, 39 years, whatever it is. So you're going to have to track that. So it really depends on the organization. No, there's not a specific dollar amount limit. I just said $500 and or $1,000 because that's what we usually see within our organizations that we work with. It should probably be a part of your accounting policies that we will talk about later. So making sure that that's in there, and then probably want to get that approved by either at least the finance committee, maybe the board too, just depending on the size of your organization. But as far as the dollar amount, it really depends on the organizations. Smaller organizations, less activity, are going to have a smaller capitalization policy. Larger organizations that have a lot more fixed assets are going to have a larger amount.
And do you have to have the same capitalization policy for all types of assets that you have?
No, you don't. So let's say, I don't know, like your computers, let's say for computer and technology, we're going to say $1,000. But if it's not computer technology, we're going to say $500. You can have different dollar amounts. That's fine. You just have to be consistent, and you have to make sure that it's like that the grouping is large enough. So we're not, every item that we bring in, we're going to use a new capitalization policy because of some reason. The other thing you should also include too is if you buy a large group of things. So let's say if we buy the same, like we buy one large purchase that has a whole bunch of furniture in it, but each of the individual amounts is less than $500, and our capitalization policy is $500. So in that instance, if we make that one huge purchase because it's more than $500, are we going to capitalize it? Or are we going to look at the individual items that make up that purchase and say, because each of those individual items is less than $500, we are going to capitalize it or not capitalize it? So that's something else to keep in mind as well.
Thank you, Carrie.
All right, so endowment policy. Okay, so next, single audit. So this will not apply to all organizations, but if you are a nonprofit and you spend $750,000 or more in government money, when we talk about government money, we are talking about money from the federal government. It could be directly from the federal government. It could pass through from the federal government to a state or local government and then to you. It could pass through from the federal government to a nonprofit and then to you. So we're looking at the original source of the funds. And then if it's from the federal government, you might have to have a single audit done. So that is a special type of audit where we not only do a financial statement audit, but we also look at compliance. So we're making sure that the money that the federal government gave you is being spent for what it's supposed to be spent for. So if you have that type of audit done, there are some different policies that they like to have, that you should have in place. Advanced payments and reimbursements. So how you get the money in, collecting the money. Procurement, there are some things that you have to follow as far as hiring different contractors, and you're using this money for that. The allowability of costs. So there are certain things based on what government grant you get as to whether what it can be used for. Compensation, again, we kind of talked about that one already, and then travel costs. So really what you want to make sure that if you do get a government grant, government money in, you spend more than $750,000, you need a single audit. But if you do get government money in, you want to make sure that there's policies in place basically to make sure you are in compliance. So you need to know the compliance requirements for that grant and making sure that you have written policies in place to make sure that that money is being spent how it's supposed to be spent. Okay, lastly, the list here are kind of just best practices. And again, this is not an entire list of all policies that you could have in place, but these are some of the more common ones that we see that you should probably consider having in place. So we kind of talked about capitalization policy. So that kind of goes along with your accounting procedures. So making sure that you have written down who does what. How is the bank statement being received, reconciled, reviewed, who makes journal entries, who processes cash receipts, who processes disbursements. You want to make sure that's all documented because number one, if somebody leaves, we know who's doing what, but then also number two, segregation of duties. It's very important to segregate duties as much as possible between the actual possession of the asset, recording the transaction, and approving the transaction. So having written accounting procedures in place can help you do that and segregate your duties better for your organization. Board roles and responsibilities. So making sure that there is a written document that says what your board roles and responsibilities are. If your board members don't understand what they're supposed to be doing, that's not good. That they're not going to participate. They're not going to be good board members for your organization. So you want to make sure that you have that documented and also provide that to them. I know I've been on some boards where there's a responsibilities form and then you sign it as a new board member. There are also, individual versus the whole board duties that you need to think about. And if you are not aware of BoardSource, I would highly encourage you to visit the BoardSource website. They have a ton of resources on boards. Specifically their 10 basic responsibilities of nonprofit boards. And you can see here on the slide, it kind of breaks down those 10 responsibilities between those that are for individual board members and those as the board as a whole. So if you don't have board responsibilities document in place already, this is a really good place to start. And then you can adjust it to your organization. Okay, credit card policy. First of all, if your organization is using a debit card, get rid of it. We strongly encourage organizations to not use debit cards, but instead to use credit cards. Using a debit cards are essentially the same as cash. If somebody gets a hold of your debit card, that is directly tied to your cash account. If that debit card gets used for something, a fraudulent transaction, it is much harder to correct that, to fight that charge than if it's on a credit card. So first thing, if you currently have debit cards, get rid of them and replace them with credit cards. So credit card policy needs to include who has access to it. Are individuals, are they holding it themselves, or is it like in a safe somewhere where you have to go and check it out? What's the available credit limit? What kind of purchases can be made? What kind of purchases cannot be made? What happens if I, as an employee, use this card and I'm charging something that shouldn't have been charged to it? Do I have to repay it? Do I get my usage of it taken away? What happens? You also need to have documentation required for charges. So if I use it, what do I need to provide? Do I need to provide a receipt, invoice? How soon do I need to provide that? And then also a process for actually reviewing the monthly credit card statements, matching up those receipts to the actual statement themselves. And under no circumstances should cash advances be allowed. That's when we get into high risks and fraud, opportunity for fraud. So make sure that people cannot take advances on your credit cards. Next, we have disaster recovery plan. So again, I think, these last couple of years, we've, recovering from a pandemic, that's a disaster. We can have natural disasters, there's floods, there's tornadoes, there's also like cyber attacks, or, you could have a disaster where suddenly you lose your executive director or board chair. Something that happens that's going to significantly impact your organization and its ability to perform its services. So you want to have some kind of policy in place before the disaster happens, because when the disaster is happening, you don't have time to figure out what to do. So you want to put this plan into place before, so that way you can resume your operations as soon as possible. So including in that plan is, communication. How are you going to communicate with your employees? How are you going to communicate to your funders, your board members of what's going on? You probably want to have some kind of public relations spokesperson, one person designated as the person that's going to speak to the media, because this could really affect and impact your organization and its reputation. So you want to make sure you have a response ready for that. As part of this plan too, you want to look at your insurance coverage that's currently in place, what kind of assets and technology that you have currently, so that you know what you need should those all go away, be damaged. So you know what that you need for each of those programs to continue providing that service. Investment policy, kind of similar to an endowment policy. If you don't have investments, you don't need this. However, if you do, I suggest that you have something like this in place. As a nonprofit, you have these funds and you're going to put some away for a bit. So when we're putting these away into an investment account, we don't have access to that. So we really need to look to make sure our cash flow needs. Is it okay to put that money into investments? And what kind of investments are we putting them into? Is it long-term investments where we can't access it? Should we need that cash? Some organizations only want to invest in certain types of stocks or don't want to invest in certain types of stocks. So if that's the case, you need to include that in your investment policy. As far as investments within a nonprofit organization, they can be managed by internally an investment committee or an outside professional fund manager. So having some kind of policy in place, what we're investing in, that type of thing. IT and internet security policy, especially with all of the issues, the security issues, the cyber security attacks that go on nowadays, making sure you have some kind of policy in place as to limits on access of your technology, your software programs. Nonprofits have a lot of confidential data, from your donors' names, addresses, your employees, volunteers, board members, if your clients, if you provide any kind of medical type of services, you might have that type of HIPAA compliance. So making sure all of that stuff is secure, who can have access to it, that type of thing. Usernames, passwords, can it be accessed off-site? Do you have to be on-site to access those types of things? Job descriptions, I think that's pretty self-explanatory, making sure that each position has a written job description. Again, should that person leave, that way you know what they're doing. Also gives them expectations as to what they should be doing for their job. Personnel policy manual, again, just making sure that general employment policies, PTO, just kind of set the expectation for how the person is going to be an employee within your organization. Also make sure that when new people start, that you have them sign something that they have, that they've gotten a copy of that policy manual. Petty cash fund, there is a risk with petty cash fund because it is straight cash. Sometimes these don't get as documented as well as, checks being issued. So making sure that you have a policy in place that says, how that petty cash is being used, how to replenish it, what it can be used for, that type of thing. Strategic plan, if you don't have a strategic plan in place, make sure that you do. Used to be that strategic plans were like 3 to 5 years. We really can't do that anymore, just with the constant change in the economy and just the world today. So really it should be continuous. Strategy is one of the board's most important roles. So making sure that you do have a strategic plan in place so that your organization can be in existence for the long term. Succession plan. So we have a lot of executive directors, a lot of CEOs retiring now, also board members, board chairs. So we need to make sure that we are planning for their succession, for them leaving the organization, to ensure that we can be sustainable after they leave. Your executive director probably has a ton of institutional knowledge, and you don't want to lose that. So as far as strategies for a succession plan, now obviously there's if they're going to retire, but then there's also, which is like the departure defined strategy. Strategic leader development would be like if you're, okay, my ED is going to retire within 5 years. We know they're going to retire in 5 years. So in the meantime, we're going to identify somebody that ED is going to work with them and bring them up to speed on what needs to be done. But emergency succession plan is something that everyone should have. And I just want to talk briefly about that. So really you should start planning for your succession of your ED as soon as they're hired, because they're going to leave at some point. Sometimes though, they leave unexpectedly and you aren't prepared for it. So having an emergency succession plan in place really helps the organization get through that. So short term is if they leave on a temporary basis, it's not planned, but they're going to come back. So maybe they have an illness, it's not huge, or maybe they have to have a surgery or something. They're going to be gone for a bit, but they're going to come back. Long term is 45 days or more, and it's still considered temporary because they are going to return. But then permanent is when they just leave and they don't tell you. So the important thing about a succession plan in any of these situations is you need to know what these people do. So you need to have that job description for your ED, but you also need to know who is going to take over when that person leaves, who's their backup. So make sure you tell them, make sure you talk to that person. Is it, the COO? Is it an assistant executive director? Is it a program director? Is it the board chair? Who is going to take over in their absence? And then also, how are you, for that permanent leave, how are you going to replace that executive director? Is the board going to do a search? Is there going to be a search committee? Are you going to hire an interim? So making sure you have that plan in place. Just like a disaster recovery plan, when this happens, you don't want to be rushing around worrying about it then. You want to make sure that you have something in place prior to this happening. So that is the last one. I know that last few were kind of rushed, but I wanted to get through all those. If you have questions on those or want copies, please let us know, because we do have a lot of templates and it's not worth reinventing the wheel if we already have that and can provide that to you. So Tyson, if you want to wrap it up.
Yes, thanks, Carrie. So just as a reminder, this session was recorded, so the slides and videos will be available on our DWD website in the not-for-profit section. A link to that section will be emailed to everyone attending today. If you haven't visited our website lately, it's a great resource. So we have all of the previous webinar recordings are on there for you to watch. You can see those topics on the screen right now. Also, Carrie has a mission-minded blog specifically for not-for-profits. It's regularly updated. For our upcoming webinars, we don't have all of the topics and dates set yet for 2023, but we are still going to hold all of our monthly webinars like we always have. We're currently working on matching specific topics to dates, and we'll make sure that we post the dates when available on our website, social media, and we'll be sending out email reminders for people who have attended webinars in the past. So be on the lookout for that information. With that being said, I want to thank everyone for joining us this morning. Have a great rest of your day.